So the following is the most simple and easy to understand explanation I found for understanding what a hedge fund is. I found it on Reddit, and all credit goes to the user I moved your G's. Trust me, it's an idiot-proof explanation. If this simple ape was able to get it, I'm sure you will too. Just keep in mind that I'm giving for granted you already know the basics, like what a stock is and what the stock markets are. If you don't, no worries. Just check out my previous videos about them and come back here. Or watch this video and then delve into those. Up to you. Now let's focus on what a hedge fund is. You and I, as individual investors, can trade a company's stock, bonds, commodities, etc. on a public market. Then, there are investment companies which offer pooled funds, where we can put in money and they will bundle it together and trade common securities, stocks, bonds, etc., hopefully getting positive returns while saving us from having to do the work ourselves. There are different types of such funds, mutual funds being the most common, either actively managed by an investment manager or tracking some index like the S&P 500. The basic idea is to buy hundreds or thousands or more securities together, to not be affected by fluctuations in a single one. Hedge funds are able to take things up a notch. They are specialized and exclusive versions of mutual funds open only to institutional investors or very high net worth individuals. They are also far less regulated than publicly accessible funds. Hedge fund managers use very aggressive investment techniques and invest in a wider array of products than just stocks or bonds, like options and other derivatives, real estate, currencies, art, precious metals, or really anything else that can be bought and sold. They often use large amounts of borrowed money, aka leverage, and so are generally exposed to a lot more risk than normal funds. They also frequently take short positions, bet that a stock will go down instead of up, in order to hedge against market downturns or to take advantage of failing companies. Worth noting, though, is that the name hedge fund originated in the 50s and 60s as in hedging your bets, meaning to protect yourself against loss by supporting more than one possible result, or both sides in a competition. Basically, such funds would optimize their investments to reduce risk, while today's hedge funds are mostly the opposite. It's more and more just a generic label used by private funds with varying, and sometimes opposite, goals and investment strategies. I'm the Market Monkey, and if you found this video useful, please hit that like button and consider subscribing and turning the notifications on. This video does not constitute as financial nor trading advice, and to be frank, you'd be crazy to follow the directions of some random gorilla on the internet.